Hi, my name is Sakine. I'm the founder of Tax Formations, which is a tax consulting firm specializing in transaction and entity structuring. Today's video is about state sales tax and when it applies to you. When are you subject to state sales tax? I work with a lot of startups who are expanding rapidly and realizing that they are becoming subject to state sales tax and basically need to figure out what does that even mean? What are the states that I am subject to it in? And, is there a way I can avoid it? So this video kind of covers all of that from a very high level. So you are subject to sales tax in a state if you have something called nexus to that state. And what nexus means is like a close proximity to that state. So if you have state sales tax nexus, then you are subject to sales tax in that state. State sales tax nexus originally across the states generally was determined using a three-factor approach, considering your business's property, payroll, and sales. Generally across the states, because every state's rules are different, some mirror each other, some match, but you have to look at each state just to be sure of their rules. You cannot assume they have the same rules because they generally don't. So the first question. The first questions the states tended to ask early on in determining state sales tax nexus is, do you have substantial property, payroll, and or sales in our state? If so, you have nexus. What is substantial? Many states would define substantial as a percentage of your total property, payroll, or sales. So, for example, in California, it might have been 25 if you have property in California which represents more than 25% of your total property across the world, then you have nexus in California. Also, if you have sales that represents more than 25%, then you have nexus. And then finally, if you have employees located in the state of California that represent more than 25% of your total payroll, and you have sales tax. So generally across the board, the states would say, if they would define a threshold and say, if you are above that in either property, payroll, or sales in our state, then you have nexus. But in today's modern world of digital online businesses where everything is online and property isn't as relevant, physical property isn't as relevant as it used to be. And by the way, I've only been talking about physical, tangible property so far. So in today's modern world where physical property isn't as relevant, there are tons of businesses without offices and growing, like physical offices, which often triggers nexus from the property perspective. And states started to realize that really it's about the sales. That's what it's about. So a lot of states have moved over to a single factor approach instead of a three-factor approach, where if you exceed a certain threshold of gross sales in any given year, then you have state sales tax nexus. That is more popular these days than the three-factor approach, which was the original approach that most states used. The single factor sales approach is not really, most businesses don't like it that much because more often than not, it increases your chances of having nexus in a state. 100,000 is a relatively low threshold for gross sales. And now you can't just avoid state sales tax by not putting a physical piece of property or employee in the state. If you're making money, you have to pay. So this transition to a single factor sales approach has led to a lot more taxpayers being subject to sales tax in the United States. So that is a very high level overview of kind of how Nexus works generally in the United States at this time. If your business is large and growing and there's already a few states that you know you're going to have more than 100,000 in sales in 2024, I recommend that you reach out to a tax attorney and have them do a nexus study to see what states you're subject to state sales tax in. State sales tax is just one of those things you want to do right. You're not actually paying the tax, your customer is. You're just remitting your customer's tax. So it's definitely worth it to do it right. You're not losing any money. And then, you don't want to be fined and penalized for not remitting customers' tax. So, state sales tax nexus studies can be done across all states, which is what generally needs to happen, or they can be more abbreviated and focused. For example, I have a client that I'm working with currently that exceeded 100,000 in sales in one state, but that's it. Doesn't see himself exceeding over 100,000 in sales in that many more states. So we were based on that client's property, payroll, and sales, because by the way, there are many states that still have the three-factor approach. I determined that there were only a few states we even needed to analyze for the Nexus study because the other states I already knew we wouldn't have Nexus. And I did more of an abbreviated study. Um, but, anyways, that's definitely something you should look into if you have a new business, it's expanding rapidly, and you're approaching that 100,000 in gross sales in any given state mark. Well, I hope this video was helpful, and I hope you guys have a great rest of your day. At the end of the video, I will have my contact information. If you have any comments or questions, feel free to reach out to me anytime. Thanks.